Okay, welcome everybody. Really appreciate your time. We've got something super excited about, and we're going to go into all the details here. So, what if I told you that we are over budgeting expenses and under projecting income, and we're still on track to deliver over a 20% annual return on return on investment to our investors? That's one of the reasons why I'm super excited about this deal. Sounds too good to be true, right? So when this came about, I spent a solid 6 weeks looking into everything possible about the deal, about the market, about the economics, looking for a reason to say no. I did not want to distract what I'm doing here in Phoenix and some other stuff I have going on. So I was looking for a reason to say no. And after 6 weeks of turning over every stone possible, well, it all led to positive things. And I was just blown away. And so here we are. We've got this property under contract. We're closing in a couple of months. And I'm excited to share it with people that I know and people that I like. So I've got, well, over the last 10 years, I've put together over 25 deals. And I think at the get-go, this one is the most exciting out of all of them. And so I think over the next 45 minutes or so, as we go through the details, you will understand why I'm super excited and why the Woody Creek Condos asset deserves a spot in your portfolio. All right. So after many years of being an entrepreneur, I have personally learned that if you want to go fast, you do things on your own. And if you want to go far, you do things with a team, with exceptional people. And so I've got some exceptional people on my team right here. Mike Escobedo is my partner. He is the boots on the ground. Mike is a 2-time Indiana state champion, and he's also responsible for hundreds of millions of dollars in real estate transactions. He's going to talk a little bit more as we get going. Leif Anderson is our fund manager, and he has been involved in software startups, dental practice roll-ups, HVAC business consolidations, and he's deeply tied in real estate. He's been investing for over 20 years. Chelsea here is, she's my marketing and communications expert. She is a prior global manager for EXP with a ton of experience working with developers and other real estate investors. And she is the strategy and magic behind bringing out my passion and my analytical nature and my philosophical thinking and putting it into words that people can resonate with. So I'm surrounded by greatness and proud to be in your company. Thank you all for being here. We were going to move forward. So quick disclaimer, this is a real estate investment and it is a 506c offering, meaning that we can only allow accredited investors. Now with any investment, it is just that. It is an investment. There is risk involved and there is no way that we can predict the future. Okay. So we do everything, all the numbers that we're going to talk about here. It's all based off of our experience and what we feel are conservative projections, but we can't predict the future. Every investment is a risk. In terms of the accredited investor life, can you help for those people that don't understand what that term means? Can you help us inform them?
Yeah, absolutely. In general, an accredited investor is either an individual or a business that has a financial means and sophistication to make investments that are not available to the general public. And typically there's a few ways that you can qualify to do so. First of which is to have $1 million worth of net worth outside of your primary residence. If it's just an individual income, you could have 200,000 per year, but I have to have it for 2 years in a row. If it's a household income combined, it would be 300,000 also for 2 years in a row. And then there's a few other ways where if you have certain certifications like a Series 7 or 65, 82, a few others, then you could qualify that way as well.
All right. So if you are not an accredited investor, you're still welcome to listen. And you never know, maybe you can participate in one of our future deals. So here's what we're going to go over. Anything and everything about the deal, table of contents, and some of these slides I'm going to flip through and you'll have a chance to review this in detail afterwards, but I need to be cognizant of time. So quick summary of the investment, 24-unit property in Schererville, Indiana. There's a lot of upside in basically what we're going to do is some cosmetic renovations and get some below market rents up to the average market rate for rents. And the property is 12 years old, very minimal maintenance. And it's a nice project. Okay. The returns that we're projecting on this are very, very strong, especially compared to all the stuff that I look at in Phoenix. And it's in a stable market, linear market, a little bit different than what we experience here in Phoenix. Some highlights: purchase price on this property is $5.5 million. We are putting in $2 million between the down payment and the CapEx and reserve reserves. Minimum investment in this property is $50,000. We are projecting a 6-year hold. We put in 10 years, but really we're looking at 6 years, and we could talk about that a little bit more. We've got 2 investment classes. Class A is $250 and up investment dollar-wise, and with that, we're offering an 8% preferred return, 70-30 initial split until 17% IRR is reached to the investors, and then the split moves to 50-50. And if you're not familiar with this, what that means is, you know what, if we hit it out of the park on this deal and we really kill it, we over project, then we get to share a little bit more of the upside. That's all that is. Class B is a $50,000 minimum. That comes with a 5% preferred return, 60-40 initial split, and a 15 IRR hurdle until the 50-50 kicks in. And later on in the deck, we'll show you what an example investment returns look like in terms of dollars and cents. Asset Stream Properties is my company. If you don't know me, this is my real estate firm. And at the moment, we've got about $20 million in assets under management. It's a business that I built myself, slowly, by myself, without the right partners. And it took me a while to build. Most of these assets are fully owned. I do have a handful of partnerships, but right now that looks, we're a little bit over 20 properties and about 100 doors. At the moment, I've got 4 of those in infinite status, which, if you don't know, means I've taken all my money out or my partner's money out, and we've redeployed that money elsewhere, and we still own those assets with no money in it. Kind of the holy grail, and that's why I like this infinity sign. But I am a conservative in nature. Our total LTV for the portfolio is 55%. So unlike a lot of guys out there, I am not over leveraged right now. And I do not sell properties very often, but the last one that I did achieved an 1100% cash on cash return over 5 years. And it was pretty nice. A little bit more about me. So yeah, I mean, I've escaped the rat race. Okay. And I did it with my own money, which is kind of cool. I'm in a position every day where I get to choose what I want to do. And what I choose to do is this right here. I hunt and I source off-market deals on a daily basis. I analyze them. I dive deep into the numbers and the comps. And I put together real estate investors because I love watching my money make money. And at the point in my career right now, I'm just hyper-focused on spreading the wealth. I want to create these positive ripple effects and bring in more people around me to share in the expertise that I've built over the last 10 or 15 years of doing this. Aside from that, I've got another company called Envision Service Group. We offer painting and roofing services for residential and commercial clients in the Phoenix area and even multi-state right now. But I've got a team that runs that. And so that's not my day-to-day. Real estate is my 100% focus and passion. And I call it my ikigai. If you're not familiar with that term, it is a Japanese phrase. And it is the intersection of doing what you love, what you're good at, what is needed, and what's valuable. And so I'm blessed and I'm proud to be in that position every day. And this right here is it coming to fruition when I get to share in partnerships. But my background, I've got extensive background in construction and project management. I worked for a Fortune 500 firm in Phoenix here for several years, building residential communities. My construction team does a lot of our work, and we've just got a lot of ties there. I've been a licensed real estate agent since 2007. However, I don't do transactions. I only use it for myself. I'm not a transactional guy. I'm a long-term equity builder. So anyway, that's a little bit about me. Our team right now, we've built in the last year or so. This is our boots on the ground here in Phoenix. Why don't you talk a little bit about yourself?
Hey, thanks, Pete. Impressive bio and record. I appreciate you starting that intro for all of us. Yeah, it was great meeting Pete on this particular deal that we've locked up in contract. I'm super excited about it. I'm super excited to bring this webinar to everyone. And thanks for having me. And thank you to your team for putting all this together for us. Right now, we're positioned to help our investors make a whole lot of money on this deal. Just a little bit about my background. I did, as Pete mentioned, I started off in wrestling, had a great career, 2-time state champ, went undefeated my senior and junior year, made a lot of big commitments and ended up landing a scholarship at Michigan State. And that's really been the driving force of my character and who I am. So I found that to be ideal when working in real estate. So, you know, I'm just like Pete. I'm the deal hunter. I would go out there and find the deals. So as you can see my track record, I've sold over $255 million in sales just in real estate alone. And that was my single job, you know, right out of college, and had some other businesses as well while I was dabbling into real estate. When I speak about finding $255 million of sales, yeah, that's a lot of hard work. And again, I attribute that to wrestling. When I first started out, I was at a big firm at Marcus & Millichap, one of the top companies, as most of the folks and investors know who they are. And I became the pace setter. I won the Pacer Award there. And I was one of the top climbing agents in that firm. And if you visited my website at Investments Elevated, you'll notice my background is in the mobile home and RV park space. I've sold as high as $40 million parks and as low as $1 million parks. So that's where I'm coming from. That's really my background in this space. So I've sourced a lot of deals, hundreds of deals. I've underwritten deals. So I've extreme amount of experience in that underwriting process and really tying the deals together in escrow and things like that. So I'm proud to have that in my background and really to work on this deal with Pete. And just so the investors are aware, I am going to be boots on the ground on this particular property. So I'm excited to do that. Why Indiana? Why Schererville, Indiana, as Pete said? Well, when we were looking for deals, I initially was looking in Phoenix because I live right here in Phoenix, and I started making a database in my hometown in Indiana. My family, big wrestling background. I said, hey, why don't I find some deals out in Indiana, and I can actually move out there and be next to the property and have a home next to my family and do real estate full time. So I decided to make a database and do a cold call session with the folks out there in Indiana and landed a deal. So I was excited to get on this deal. I passed it over to Pete, and when I passed it over to Pete, we try to beat it up as much as possible for 6 weeks, and we couldn't find any holes. So I'm excited about that. And so I'll be boots on the ground there when we're tearing into the property to do the Reno schedule that we've got lined up. I've got plenty of management experience. I also ran a painting and construction business, so I do have the background and the knowledge when it comes to that management. And as a matter of fact, here in my Phoenix home, I actually did my luxury flooring in the house. So I can push the contractors out there and make sure they're getting the job done and doing it right and making sure we're getting the right product at the right price as well. So enough about me, Pete. I know you've got some other things lined up on this webinar, but if you guys have any other questions to learn about our background, please ask us.
Yeah. So Mike, good stuff. Mike's a rock star in his own world for sure. Construction experience. He's even got property management experience. His wife is an ex-property manager. So all across the board, he's boots on the ground. Winning team. I mean, man, we talk every day and we just hit it off. And we've talked about, I've seen many partnerships fail and I've seen some partnerships take off like a rocket. And I think we're at the beginning of a rocket because we are just so complementary. So my role in this from Phoenix is basically the support. I'll be helping do everything remotely, but Mike will be the boots on the ground. So I mentioned earlier, if you want to go far, you go with partners. There's a book that I read a while back called Who Not How, and it is amazing, but it goes to say the importance of collaboration on hitting your goals. Okay. And so if you've read that book, you might resonate, but everybody here is somebody else's who. Okay. You guys watching this as the investors, we are your who, okay, to create these returns. You, as the investors, are our who to put this deal together with the money. Mike is my who to be the boots on the ground. I am Mike's who to pull this all together in the back end and help things asset manage and keep things coordinated. Life is our who, helping with the fund management and investor relations. Chelsea is our who for putting this beautiful deck together and making it in words that actually make sense to people. So who's your who? Who's going to help you get to that next level and achieve your goals that you just set for this year? Hopefully we're that who for you, and this is a good start for your year. Let's move through this a little bit more and get to some good stuff. All right, investment highlights. This deal has no banks, okay? The bank is the seller, and we negotiated this with the seller. The seller is the person that built this property 12 years ago, but we've got incredible terms here. It's a 6-year term, step up rate starting at 3.25% for the first 2 years, goes up to 3.75 for year 3 and 4, and then 4.5 for 5 and 6. So it's a blended rate at 3.88%. I mentioned it's a 6-year hold. We actually also negotiated into this deal that we can extend this loan, this note, for an extra year for only 0.5%. It's ungodly cheap. Like any bank or other way that you're going to extend a loan is going to charge at least a point, maybe 2. So it just gives us an extra year if we need to, or even if we want to, if the rates are not better than what we've got right now and we're cash flowing, it gives us another option. Strategic value add, like I said, we're doing some cosmetic, simple stuff on a 12-year-old building. There's nothing major, but the market rents are just way below market. We're going to get into that a little bit more. This $2,095 per month dollar amount is actually less than the average of the comps. Okay. And so we're being ultra conservative, and there's more to come on that. Exit strategy, flexibility. So this is not your typical apartment. These are 24 individually parceled condos. And so we are buying them together. The seller built them together as a package, but it just gives us one more option, should I say, in the future if we wanted to sell off the units individually. I don't know that will be the right strategy, but options are good. Okay. The financial projections on this property, when we pencil this out super conservatively, which we're going to get into, are incredible. 16 to 20% IRR, over a 20% average annual return, and more than doubling your money in 6 years for the investors. All right. Right now we've got 2 vacant units, which gives us immediate access to go in and get some work done, get our system dialed in, and either have a model home or just keep things turning. We've got a whole turnover schedule planned, and it'll be nice to really just get started without having to wait. All right, the business plan, simple. Like I mentioned, we're going to go in and renovate units, increase rent. We're going to have to move some tenants around, but that's part of it. We will offer the newly renovated units to the tenants that we need to move out, so hopefully it's not too much pain there. These units are all 2-bedroom, 2-bath condos, 1,350 square feet each. This right here is a video of one of the balconies. We've got more videos coming to show you exactly what this property looks like. There's the Woody Creek back there. Nice spacious balcony. They even have ceiling fans up there. Here's the interior of one of the 2-story units. I'll let this play a little bit. As you can see, they've got nice vaulted ceilings. These units all have their own garages. It's in an upscale neighborhood, and they're all individually metered like you would expect of condos. Here's an aerial overview. So this is the property right here. This is actually not included, correct, Mike? These are different units where the asphalt turns white.
Yeah, the north side is not ours. So you'll see that black top or black asphalt there on the left hand side. That's all part of Woody Creek.
Yeah, so
going
right
down
here
to the south.
Okay, some market stuff. So this is a summary of everything that we've kind of dug into those first 6 weeks, trying to figure everything out. So Schererville, it's kind of a hidden gem. It's a small town. It was actually ranked one of the top 100 best places to live in 2007 by Money Magazine. It's got population growth. It's 45 minutes outside of Chicago. And so what we find is that a lot of these people, they work in Chicago and they live in Schererville. It's a nice upscale suburban neighborhood where you can get a lot more bang for your buck. And it's just a lot more family friendly. People that want to work in Chicago but don't want to live there. The rental market is strong out there. Vacancy rates are low, and it's not really on the radar. There's not a lot of construction or new supply or anything like that. It's limited, high demand, limited supply, and it's not like a big town where we've got developers coming in building a whole bunch of stuff. Economic drivers in the area, there's a big manufacturing firm there, and then Franciscan Health. Those are the 2 big local economic drivers. But like I said, a lot of it's coming from Chicago. The town itself is outpacing like the average job growth of the U.S. Okay, there's some local government incentives to build the neighborhood, or like increase in infrastructure improvement, stuff like that. So it's a cool little town. Mike was just out there a couple weeks ago. I am heading out there this weekend actually for inspections. And some more stats here. Crime rate in the neighborhood is rated a 9.8 compared to the U.S. average of 22.7. The town is like right off the highway, right? So Mike, when you pull off the highway, how many minutes till you get to Schererville?
Well, that intersection is the crossroads. So you can take that, it's US 41. You can take that north and really get closer to Chicago. You can take US 30 straight into Illinois. It's probably 10 to 15 minutes, and now you're in Illinois. So you get a lot of crossover there in that market. So, those folks in Chicago definitely don't want to pay the high taxes, but want to make the big bucks. So they'll prefer to live right there in Schererville and commute right into Chicago. It's a 45-minute drive, so it's great.
Yeah, cool. All right, some cool trends that we saw for the area. Last 10 years, home values increased, an average of 5.5%, okay, per year. Pretty good stat. It's what we would expect, actually better than what I expected. This town, Midwest market, is considered a linear market. So if you're in Phoenix, like I am, Phoenix is considered a hybrid market, all right? And so Phoenix might be a little bit more dynamic in terms of appreciation, maybe a little bit more upside and some more downside. downside, right? In the bad times. Cash flow is not going to be as strong. In this market, I would expect higher cash flow and maybe a little bit less appreciation. But 5.5% over the last 10 years is a solid number. And I'll tell you, we're planning for less than that in the next 6 years. What else? The average household income out there is 81,000. So like mentioned, it's an affluent area. He called me when he was out there a couple weeks ago, and he's like, Pete, there's Mercedes. I saw a Lambo. There's people out there are doing well. They've got big houses, and it's a good cost of living. Property taxes in Schererville are 28% lower than the national average. And out there's not really any major natural disasters. It's not in Florida with the hurricanes, or it's not a fire zone. So the insurance rates are, what you would expect, fairly reasonable. Median housing values out there for a home is $349, and a condo value is $335. Price per unit we're buying this at $229. Mike, you got a call from somebody recently out there, from a broker, right?
Yes, I did. Yeah, when we've locked up the property, we were hunting for some more brokers to find some good deals out there, and the broker actually found our marketing material online, and he contacted me and told me, hey, you've got that deal out there in Schererville. We can, if you want to flip the contract, we could definitely find somebody to take it and pay you a fee on the contract. So that got me excited, and I'm sure it got you excited, Pete, when you heard that. And also, as we've been shopping for property managers out there, all the property managers are willing to take this because it's such a nice property and a great location. So we're not having any trouble with the property management out there to be boots on the ground with me along with the property. But Pete, I know you've been speaking about the market, and just so I can dive in a little bit, interject there. I'm from the area. I'm very familiar with what's going on in Schererville. And when you mentioned earlier about the area, these condos are situated in a very good school system as well. I went to Lake Central High School, and that's where the tenants will send their kids, is Lake Central. So they used to call it Tri-Central because it's 3 towns that connect into the school, and Schererville is one of them. So they're getting a great deal with a great school, great education. I had a class my senior year, my freshman year, around over 3,000 kids. So it's a very large school, and most kids want to be at Lake Central for the education. And that's a great deal that they're getting out there with those condos. And not to mention, when you look at the drivers that are there in Indiana, it's mostly blue collar. At least that's what I grew up. The folks were going to middle and ArcelorMittal, the steel company that's out there. Most of the guys work out there. The BP oil plant, a refinery. A lot of guys are working out there and have done 40 years or more in that sector. So the guys are giving their lives for those industries. And same with the Franciscan Health Hospital. That's just around the corner. So these are major employers that are continuing to hire and keep that and retain those workers in the area. So we're not going to have any trouble with that growth or that stability.
Yeah. Thank you for adding that color, Mike. Low
Absolutely.
Unemployment rate, 5.9%. It's a blue collar town, stable market, everything you might expect. And everything is really checking out super nice. So migration trends, here's a quick map. I don't know where we found this, but it talks about where people migrate. I was a little bit surprised because you get a lot of people coming from New York, actually, there. Peoria, St. Louis. Chelsea, you found something recently also about migration, right?
Yeah. U-Haul every year publishes an article that shares just where people are migrating to and from. And there's no data on Schererville specifically, but Indiana was number 8 in the nation, which is pretty significant in terms of.
What was that again? 8 in the nation for what?
People relocating into Indiana.
That's insane. Into the state, Indiana. But it goes to show people are moving to affordability right now, right? They're moving out of places like New York, California, and they have been for years, and that's not going to change, right? This is an affordable town. Here's another stat that's slightly different than the other stat we saw, but again, unemployment at 2.9 compared to the other stat. It's a good town, right? People are working, things are moving forward. All right, so this is one of the things that blew me away. Indiana is also considered one of the top 5 most landlord-friendly states in all of the United States. All right, right next door is Illinois, in Chicago. You don't want to own property in Illinois as a landlord. You just don't. There's certain states where you do not want to be a landlord, and Illinois is one of those. But Indiana is the complete opposite. So we take it for granted here in Phoenix, being in a landlord-friendly state. I will say that my wife's family owns property in New Mexico. They've had somebody in one of their houses for 3 years and haven't been able to get them out. They're not paying for 3 years, right? And so this is a state that is good to own. Similar to us, 10-day eviction notice, no rent control. But here's something that we don't have in Phoenix. Immediate action if there's property damage. So if somebody causes significant damage to our property, we can go kick kick them out that day. And so I don't know how that would actually work out in real life, but it just goes to show that it's a good place to own real estate because you've got control, right? So market stats, renter occupied units account for 20% of the housing stock compared to the national average of 30%. What this means is there's good occupancy, balanced rental demand, supports steady income, right? So all the numbers just are reflecting positive amounts. Low property taxes. Not only is it landlord friendly, you've got low property taxes, which, what is it? The 8th lowest in the country. And then you've got reasonable insurance rates. I couldn't find a stat on where that fits, but I know that it's not anything outrageous, right? So it's all checking off these boxes. Is this an area, a state, and a regional area that makes sense to own income property in general? Here's some additional info that I found on ChatGPT, and I'm not going to go too far in depth, but when you're reviewing everything on your own after this, if you want, feel free to check this out. It talks about some historical trends, current trends, and future projections, all aligning with everything else that we're talking about. All right, let's talk about the numbers. $5.5 million purchase, seller finance at $4.4 million, down payment is $1.1 million, total capex, reserves, closing costs, and equity $900,000 and $500,000. So I rounded it up. $2 million is the total raise, but that's how the capital breaks down. And this is the offering summary. Like I mentioned, we've got two classes here, Class A and Class B, $50,000 minimum. I didn't mention it earlier, but if you have questions while we're going along, plug them in the chat. And if we don't hit those by the time we get done, we're going to do a Q&A session. We'll go over all that, okay? Projected returns, which I hit on, and we've got some more detail here. Here's how the classes break down. Class A is $250,000 minimum. Again, we're raising $2 million. We're not sure exactly how many investors we're going to have, but that we split it up because, well, we'd rather have fewer investors than more. Okay, we want to blend, but it's just easier to do deals with the fewer the better. And so if you're going to put in a bigger amount, you're going to get a better return. Preferred return, if you're not familiar with this means you're the first to get paid before any equity distributions. All right, and so basically the investors are going to get these preferred returns before we're going to get any distributions. All right, after that it's the equity split. So additional distributions after the return will get split these ways, 70-30 or 60-40. And the hurdle, like I mentioned, this is going to come into play if we hit it out of the park. And if we really just we do a bang up job and we over deliver like we're expecting to, then we're going to share a little bit more in the upside. All right, this is example returns. Now, like I mentioned early on, I don't think I've ever heard of any real estate deal ever that has produced the exact returns that it's projected. It just doesn't happen, right? But you do your best to come up with what you think is going to happen with conservative underwriting, and I've got more of that to share. But if everything happened exactly how we planned it out, this is what that return would look like. Class B, if you were to invest $100,000, you would get that $100,000 back. There'd be an extra 116, okay? So that's more than doubling your money. The IRR calculation on that is 15.4. Average annual return is 36, and overall cash on cash return is 7.5. Class A, we've got two examples here at 250 or 500. Again, you get paid back your money first. This is profit on top of returning the capital. The equity multiple is a little bit higher. The IRR is a little bit higher. Average annual return is a little bit higher. Cash on cash is a little bit higher. And so I'm going to test life right now on the spot. Do you know what is the difference between IRR and AAR?
We're looking at different time frames. So as to the internal rate of return and your annual average return.
Yes. And to go a little bit further on that, for those of you that are still a little bit confused, average annual return is you take your total return and divide it by the number of years. All right. Here's the difference. You might have two investments that you're looking at that have the exact same projection. One of them pays you all of that return on the last year. The other one pays you all that return in the first year. Okay. Two different investment return profiles, but the same average annual return. That's this number. The IRR puts a time component to it. And so this is how you equalize those two investments. This is how you take those two that pay back at different times and compare them apples to apples. And so that's all it is. It's a slightly different calculation, but it's time-based. Okay, so I mentioned that we're a little bit conservative on our underwriting. Well, really conservative on our underwriting. And we're still projecting these returns, which frankly, they're quite amazing compared to what I normally do. And so let's take a look at some of our key assumptions in our underwriting, because these levers, you could be less conservative on these levers and make the numbers look better, and vice versa. It's a balance sometimes between project these. So one of the key projections is the appreciation rate. So we plugged in 3% annual appreciation in the value, the income, and the expenses. Straight line 3%. It's usually what I underwrite my deals at. Like we mentioned earlier, Shearerville has experienced 5.5% average over the next 10 years. Now, nobody knows what the future holds, right? I feel like 3% is a safe bet. The reality is well, I went through the boom and bust of 07, 08, and I feel like, and everybody that I talk to that's a big player in real estate right now seems to feel like that we are somewhere at the bottom of a market cycle, right? And if that is the case, I would just naturally expect that we are going to experience a whole lot more appreciation than 3% over the next 6 years. I'm hoping so. I'm going all in, right? But this is how we pencil it out, and it's still projecting these amazing returns. Vacancy. So like we mentioned, the first year we're doing a big project. There's a lot of units we're going to turn over, and so we have an entire schedule that does the math on that. And well, the math on our schedule is this is padded from that. So if our renovations go exactly how they're planned, I think it said that we would be at a 16 or 17% vacancy rate. And what happened is we added some extra time for our turnovers. So that 16% vacancy rate means we could do the renovation on a unit in 30 days and we could get it leased up in 30 days. So a 60-day turnover time per unit. We padded that to 75 days in case we get some inclement weather or whatever. That bumped up the vacancy rate to 20% in year one. And we went ahead and added an extra 3.5% just to be ultra conservative. So 23.5% vacancy in year one. After that, we moved the vacancy rate after stabilization. Year two, we have 10% projected. Year three and on, we're at 8%. So an 8% fully stabilized property, that equates to 2 units vacant at the entire time after stabilized. Mike, what are your thoughts on that?
Yeah, I think that's very conservative underwriting. I agree with it. When we looked at it as far as the 75-day cycle on a turnaround, I mean, that's plenty of time. I've done my luxury vinyl flooring, as I mentioned earlier. It only one-man job. It took me a month to do that. So imagine a team, imagine constructors, imagine professionals doing that. And with a smaller space as well. So we should be able to knock that out very consistently without any problems. We should have enough time to do that. So I think we're being very conservative on that vacancy rates, and especially when we're trying to stabilize up in the second year and the third year. I think it's right in line with the market, if not better.
Yeah. So the Indiana state average was like 7 point something, and everything that we find out about Shearerville indicates something less. There was a stat we saw at one point, November of 24 was 1.5%. We've seen stats in the 4.5% range and 6s. So I will say here in Maricopa County, we've had record evictions this last year in 2023. So vacancy rate's been pretty high. And so if Indiana is experiencing something similar to that, and it's still got a 7 point something percent state average for vacancy rate, I'm already seeing that vacancy rate drop quite a bit. Like the occupancy is picking up in the last quarter for sure, for me and everybody else I know in Phoenix. And I would imagine the same thing is happening, but maybe on a smaller scale, less percentage wise in Indiana. All right. So we talked about vacancy. What about the rental rates? That's the income driver. We mentioned we want to rent these for $20.95 per unit. Right now they're renting for what, $14 to $15.50. So the comps out there range from $2,000 to $2,500. And when we look at what legitimately would the comps be, and we average them out high to low, the average is actually lower, or the average is higher than $20.95. So what this means is we're going to have the nicest and newest units for the average price. We are not trying to push the market rate. We're not trying to do something that hasn't been done before. We are not like getting risky in this department. This is an ultra conservative rate, and just another reason why I'm really confident that we're going to over deliver on this project. And then lastly, the reserves. Okay. So in that $2 million raise, we have 143 upfront reserves just to have padded in the bank account for us. And we came up with that number because it's 1 year of mortgage payments. 143 just sitting in the bank. We're also in the P&L includes a $6,000 a year addition to the reserve budget. So we're going to have plenty of money in the bank. There's going to be zero financial distress. And that's all included. And so that's another lever that people can pull. If you under raise or don't figure on those reserves, it just makes your numbers look better. But we are over raising and still delivering great numbers. And then the renovation budget, or total budget for the project, equates to $25,000 per unit. It's $20,000 for the interior and $5,000 for the exterior, and $20,000 a unit for a 1,350 square foot condo is going to go a long way. And Mike's got resources out there. Go ahead, Mike.
Told you yet, but I actually got a call today. You know, as you know, this is near my hometown. I've got family out there, and they've been seeing the marketing going out on the web and social media, and they've already called me. They've already got four folks or four families that want to rent the apartments or the condos already. So they also mentioned that they're looking for really nice condos just like this, or living spaces with affordable rents just like this, so they can commute from Chicago and back to Indiana and enjoy the taxes. So that just speaks volumes of the market and what the tenants are looking for. And this is something that they're looking for.
Yeah, good stuff. So all the major levers that you can pull and be over conservative or under conservative are right here. And honestly, like, this is way more conservative than I generally underwrite deals in Phoenix. And we're still delivering returns that look better than what I do in Phoenix. And so I think we're going to even over deliver on these, but that's how it's shaking out. So let's take a look at some videos here.
Yeah, and I can describe what's happening here on the left-hand side there, Pete, because these are my videos. This is just around the corner. It's driving right down the street. Janus Drive is just north of here. And as you can see, we're coming up to a subdivision right here with all the cobblestone right at the stop sign. As you turn, you'll start to enter that neighborhood. Really nice, affluent neighborhood. The house on the right is one of the homes that's in that neighborhood. So we're talking $1 million homes, very large. Over that house is probably 5,000-6,000 square feet, maybe more, but they're just beautiful. Right there on the left, right there on the left video, take a left, and now you're on Janus Drive. So that's where the property's located. As the right side continues to roll, you can see more beautiful homes, all brick, and great landscaping. It's just a wonderful area to be in, and that's what makes me super excited just to be in this particular neighborhood. Here are some local comparables. On the left side, this is just right down the street from Woody Creek. These are our competition. So as you can see, you've got some garages out there in the back that are detached. They're not connected. So the inside are standard condos. So they're a little bit lower end, and they're right around, I believe, $1,900 on the market right now. So that'll be some competition there. On the right side, that's again on the east side of Woody Creek, just a stone throw away. And these are the higher end condos. They're renting around $2,200 to $2,300 a month. Very nice insides. They've got the granite countertops, luxury vinyl flooring. Very nice neighborhood, a pond that's just behind there that actually connects to Woody Creek. The flow, that creek that sits in the back there of Woody Creek. So that's nice.
So
but they all connect.
These are rented for $2,200 to $2,300. They're upgraded
right.
in a manner that we're going to upgrade, right? But the reality is we're going to have the newer stuff. We're going to paint ours on the outside, and we'll be renting for $100 or $200 less than them, right?
Right, exactly. Now here you can see all the flowing video. It's pretty cool. This is what's happened in the neighborhood. You've got plenty of entertainment just around the street. This is probably, I would say, maybe 5 or 6 blocks. It's literally around the corner. And this is US 41. Very, very busy. Lots of traffic running down 41 nonstop all day long. They've got new construction coming in. That's a brand new Wendy's. They've got tons of restaurants and hangout spots. And they've got your local home improvement of Home Depot just around the corner. So lots of folks hang out there. We didn't capture the movie theater that's just around the corner, just behind this. And then not to mention on 41, they've got luxury dealerships. They've got Mercedes-Benz, they've got Lexus, they've got everything that you need for the tenants that are there.
It's important because when Mike first told me Shearville, Indiana, my first instinct was it's some rural area in boondocks, like where there's nothing there, right? But it's complete contrary to that. So this is our property right here. Mike, take us a walk through this drive-by. This is Woody Creek.
Yeah, this is Woody Creek. This is on the south end. You'll see that these are 4 garages. These are the only detached units, and then all the rest are all attached. Beautiful, beautiful scenic views here, especially with the pine trees. But I'll let this video roll a little bit so we can see this. Now you can see some of the trees there. So I did go out there back in December. So you'll see during the spring and the fall months, the landscape is pretty nice. I mean, these trees will have their leaves green and it really brings out the property. So right now you're not getting a full aspect only because of the timing. But if you drop down on Google Maps on this particular property, you'll see those were shot in July, and it's actually it's beautiful. I love the views, and it's spectacular right now just viewing it here. But that'll give it a different feel.
Yeah, these are not your typical apartments, right? These are nice. So I was telling Mike earlier, like, look, they even have windows in their garages. It's a little detail. So I have windows in my garages, and my neighbors told me I have the nicest house in the neighborhood because of the windows in my garages. So, those little things. But look, these are 12-year-old buildings, lots of brick, siding. Just imagine what these buildings would look like with a fresh designer paint job, fresh black asphalt, and all that curb appeal, and it's renting for less than that other comparable property down the road. Not a lot of cars in the driveway is a good sign. They're either in their garage or they're working. All right, let's take a look at some of the insides.
Yeah, so there on the left, Pete, you've got the fireplace, as you can see, situated there.
Sorry about that.
I'm just panning the living room, as you'll see some vaulted ceilings, and the kitchen. There's the kitchen, standard appliances.
I wouldn't call that standard, Mike.
Yeah, you're right. You're right. It's a little bit above standard. That's correct.
Look at the staggered cabinets. You don't get that in a typical apartment. Like that's nice. A lot of single family homes, you buy a D.R. Horton home and they're not staggered cabinets. They're straight boxes. You get the nice crown molding there. So that's what I see. Like I see these little details. I used to build houses, so I see those little details, and all I see is the vision of what this could be. Look at this old carpet, the old flooring. Picture that with a beautiful LVP floor buttoned up to it. Some nice granite or quartz countertops with a backsplash there. Designer paint, would do a bright white and a navy blue or whatever. I mean, I've got a designer on staff, so I'll let her pick the colors. Something that appeals to the ladies, I'm not good with colors, but we'll figure it out. And then some nice hardware, right? Like those 3 things are going to make a huge difference.
Absolutely. When you walk in there, it's going to make a supreme difference. It's already nice, as you said. The reason why I call it standard is because we're lifting it up. So that's our standard. That's a high bar right now, but these are going to be great to look at when it's all finished and finished product there, especially with the money we've got projected and planned for it. We'll have some nice options to go in there.
Yeah. I can't believe the size on these. 1,350 square feet for 2-bedroom, 2-bath is bigger than my first house. Okay. At a 900 square foot house. I thought that was big at the time. These are very, very spacious. You saw the size of that first closet in this video. So here's an example. One of the things we talked about was whether or not we're going to do these showers. And if you'll see, this is a clean shower. Tile walls and a pan there. This is not worth money switching out, in our opinion. So this is one, when we say we're going to do strategic updates, like we're not doing everything because I don't think we're going to get more value, especially as a rental, in redoing the shower with as clean as that is. Right, Mike?
Right. Yeah. I don't think we need to tinker with that. It's nice. These are move-in ready products right now. So they're renting them out right now as is, and they're getting it rented. So I don't think it's anything we need to worry about, but just taking care of the more other items that will make that lift to a luxury feel. Here's the back of the condo, as you can see. That's Woody Creek going across, and there's our competitors towards the back. Now, this might be just a little wash or something that collects maybe some rainfall. I don't think it actually has a creek running through.
Yeah. All right. Well, let's take a look at the timeline and how this shakes out. Time is of the essence, as is in every real estate transaction. So right now we're on January 9th. It's available to the public. And so that's why we're doing this webinar here. Soft commitment deadline is the end of the month. However, if you're interested, I would highly suggest you do it much sooner, which I'm going to talk about in a little bit. As you can see, this is a nice property, a nice investment. And I think we're going to fill up quick. February 14th is when we're going to need the firm commitment and signed legal documents due. Like I mentioned, we're still in process with having the legal paperwork finished. That should be done here in a couple weeks or so, but this is our deadline for a firm commitment. Okay. And then 1 week after that, we need the money deposited, wired into the accounts, and then we're closing at the end of February. And so the way the process works is pretty simple. You make a soft commitment. We've got a whole portal, an investor portal, which is kind of cool. And you can do that through there. Paperwork, once the legal docs are ready, you'll have your chance to review that. And if for whatever reason you don't want to proceed, that's perfectly fine. Nothing is firm until you sign off. So everybody will get a chance to review that, and then you fund your investment. And so that is it. That is the property. Super proud of it. By now, you've seen the numbers, you've seen the strategy and the vision behind Woody Creek. You've seen how we've planned for every scenario and have been ultra conservative in our underwriting. We've got contingency plans and reserves, and we're still delivering returns that can change lives. So if you're ready to take the next step, scan this QR code. It's going to take you to our offering page and our investor portal. From there, you can click a button and do a soft commitment. And that's exactly what it is. It's a soft commitment. You plug in your name and what class you want to invest in and a potential dollar amount. At this point, we already have a couple commitments come in, and we haven't even released this to the public. Savvy investors know that this is a deal and they're not going to let it slip by. We released it to my existing investors just a few days ago, and some of them are already jumping in on it. So if you have serious interest, do this now, sooner rather than later, because the reality is $2 million is not going to go very far. This is not a $30 million deal where we need hundreds of investors, okay? The savvy ones are going to jump on this, and if you want a piece of the action, you need to get in because it's first come, first serve. And the reality is if you change your mind later, it'll be easier for us to take you out of it than it will be to add you in. All right. We will take backups for sure, but it's a good one. And I wouldn't let it slip by. If this is going to help you reach your goals, I wouldn't wait for another one. So final thoughts. As Warren Buffett said, the best investment you can make is in yourself. And the second best investment is real estate. As Kenny McElroy says, multifamily real estate is the perfect balance of risk and reward. With consistent cash flow and the ability to add value, which is what we're doing here, it's one of the smartest investments you can make. And lastly, as Grant Cardone says, every piece of real estate I didn't buy is the one that I regret the most. We thank you so much for your time and consideration. May the best days of your past be the worst days of your future. And if you want to stick around for questions and answers, we're going to go into that now.
Great.
Chelsea, what do we got? What do we got keyed up for some questions in the comments?
Yeah, we've got some questions in the Q&A here, and I just want to share with everyone, if you do want to add questions here, it's not the chat button, it is the Q&A button down at the bottom of your screen. So go ahead and pop questions in there. I've answered a few of those, but there are some that I will share here with Pete. So Tom has a few questions. First, who's in the GP? How much are they investing in cash?
Good question. Mike and I are in the GP right now, and life is a part of what we're doing in terms of cash. Great question. So Mike and I have already wired over 300 grand to lock up the earnest money. We're paying due diligence fees and inspections and appraisals. So we've got a lot of money out of pocket already on this. The question of how much do we invest? Well, it's a good one because you know, it depends on how much the investors want, honestly. Like I was telling Mike when this first came about, I wanted to do the deal on my own. Okay. And I'm not this liquid, but I've got some assets and I've got a refinance loan lined up right now that will give me a cash out refinance of at least $1 million on a handful of my properties that I was ready to redeploy into this and just say, Mike, this is just me and you. We're doing it together. And then we started talking about it. And I remembered that it defeats the purpose. It defeats my why. Okay. Why I do this is to spread the wealth, spread the ripple effect, bring in more people into my network. And so although keeping it to ourselves, you know, we could add a couple $1 million to our balance sheets and that'd be good. But the reality is Mike and I have huge goals, way bigger than any single property. And we can't get there by just keeping it to ourselves. All right. And so we've decided we're going to open this up to investors. We'll bring in investors. And the reality is, I think this $2 million is going to go quick. And if that's the case, all the investors will get all of the investor pool, and whatever's left, if there is a gap, we'll be bridging it. So I hope that answers your question. But the reality is that our reputation in what we do is way more valuable than any dollar amount that we can make on a single deal. Okay, we have huge goals. And that is really where it's at. What else?
All right. So Tom is also asking, he says, I'm confused why the seller would do this deal at all, let alone at the low interest rate they are offering. Why? They could just borrow $1 million if they need that cash, and surely the deal is cash flowing for them more than 5% per year. Good question.
Great question. Mike, you want to take this?
Yeah, Pete, I can handle this one. Yeah, so that's what I'm good at, Pete, and is really locking in those relationships, negotiating the deal. So I was able to negotiate everything that you see there, seller financing, constructing a deal. One of the main questions, just to answer that of what you mentioned, why would the seller do this? Well, just speaking with her, she owns Free and Clear. She built them 12 years ago. They've managed hundreds of these all across the nation. This is really her last one. She's retired and she just wants to sell and cash out and live on the rest of her days out in Florida. So we really caught her at a prime time, and just being able to negotiate this was awesome. It's going to be a great story for all of us, all the investors involved in this particular deal. So she's helping us. She's very, very good, a good person, and it's great to speak with her. But yeah, we're going to do great things with this particular property, and just how we're able to secure this.
Yeah, she's the ideal seller. You know, it's a convenience thing, and that's usually what I'm looking for too. We find a seller and we solve a problem for them, and it's a win-win. She gets what she wants. She doesn't have to go through showing these units and listing it. That's a pain in the butt when you own multifamily properties, trying to list a property and coordinate all these showings and then have the risk of a buyer backing out. She did her due diligence on us, and she has trust and confidence that we can close the deal. That's the reality, right? And so she's believing in us, we're believing in her, and we worked out terms, seller finance terms, that make sense for us to buy it, right? So cool. What else?
All right, we've got a few more questions here. So last question from Tom here is around flood risk and insurance for the property.
Good question. Yeah, we've gotten the title report. It's not a flood zone, and we're in the process of bidding out insurance right now. Mike, do we have any initial quotes yet?
Not yet. No, it's too early on, so they're still working it.
Yeah, we've got the price that the seller has paid right now from her prior financials. So we're using that. Actually, we padded that just in case, but we've got 3 contacts, brokers, local brokers that we're in the process of bidding it out with.
So Dean is asking what documents will be sent out for review in addition to this deck and the video.
Yeah, awesome. So if you scan that code, it'll take you to our offering page, which has basically the overview of everything, and it'll have a link to this, a couple of videos. We're going to link this webinar. Other than that, we'll have the private placement memorandum and all the legal docs once they're ready.
All right. And so Matt has a similar question. He has a few questions. I'm just going to share the first one. Do you have detailed projected financials available?
We do, yeah. If you want to deep dive into the pro forma, I'd say reach out to one of us, and we're happy to walk you through it and show you how we came up with everything for sure.
All right. He was also asking about the story of the seller, so we were able to answer that question. Another question is, what does the property management selection process look like? When will these PMs be selected?
Great questions. Mike, you want to take this one?
Yeah, we've got quite a few property managers right now giving us quotes on the property. We've got them lined up, but really it's just making the commitment on which one we want. So that's kind of where we're at right now.
All right. And Matt is also asking, what is the backup plan for financing if it doesn't make sense to sell in year 6?
Well, the backup plan is the extension that only costs a half a point to extend. But I think basically the plan is, about a year prior, we start positioning it to sell. We didn't talk about it, but Mike is, we didn't talk about it much, but Mike is a real estate agent and I am a real estate agent. And by the way, we are not paying any real estate agent fees in this deal. We're buying it direct from the seller. She doesn't have a broker or anything, but I think about a year prior to that 6-year mark, we start positioning it for sale. Mike's got a database of 10,000 buyers. He's done hundreds of millions of deals. So, I don't think we'll have a problem there, but the backup plan is that 1-year extension. And the reality is the seller doesn't want to take this back. We could probably negotiate a multi-year extension if we wanted to.
So coming back to the flood risk and insurance, Tom is saying in this area of extreme weather, he would just be concerned that the creek might flood the property. Have we asked when it last flooded?
Mike, I don't think we have any info on that. I know it was not in a flood zone when we looked at the title report. From what we understand from the tenants, there's not really any water. It's not an active water pathway. Mike, do you have any additional comments on that?
I haven't done any research on that either. I did look at the floodplain aerial photos. There's nothing in that vicinity to worry about. And just being from the area, I've never heard of a flood being in Cherville. If there was, you probably have to go into the archives, but I couldn't tell you the last time, at least my remembrance. So
yeah, I think if there was a flood risk, we'd see it as an indicator in the insurance rates that the seller's been paying, but there's not. It's what we see so far is pretty reasonable. What else?
All right, that is all the questions we have. So if anyone else has any more questions. Oh, okay, Matt. One just came in from Matt. Are these all slabs?
Oh, the foundation. Good question. Mike?
I'm going to assume so. That's not something I would know at the moment because we just did a fast walkthrough, but on our inspection, we can figure that out. We'll be going out there next week, so we'll know more about that.
Yeah, we've got the property inspection scheduled Monday. I'm flying out there Sunday, actually. I'm going to be out there personally. So we're going to get into all the nooks and crannies and stuff. I guess it's really tough to tell by the drive-by whether it's slab or if it's some kind of built-up foundation, but I didn't see any piers on anything out there. Like all the construction that I saw looked like a typical slab on grade, but I guess I can't say that with 100% commitment right now.
If anyone has any additional questions, now is the time.
All right. Nothing else. Well, I appreciate everybody's time. We're going to wrap up here. And of course, if you've got some more questions, you want to talk through it, walk through anything else, you're definitely welcome to reach out to myself, to Mike, or to Life. And we are available tomorrow. And we, even though it's probably not on our calendars, we could probably make calls this weekend because time is of the essence. We want to get this done, and we need to move quick. We're looking to solidify things quick, right?
If you go to the next page, Pete, if anyone wants to book a call, there's a QR code there you can scan on the following page.
There you go. If you want to book a call with me, you can go right here. We don't have Mike's page up here. If you know Mike and you want to talk to him, you could probably shoot him a message. He's got his own link, but this is mine right here. All right. Thank you so much for your time. I wish you the best and I hope you win tomorrow.